What a week.
It's been a week for sure, John.
This move in the bond market, you seen a recipe for further bond market stability after that payrolls report?
I mean, I do. And I think it's not just about the payrolls report, but several factors that have been propping up the bond yields here. You know, first of all, the payrolls report was picture perfect, I would say, for the Fed, for the equities market, and for the bond market. The reason I say that is because we got an uptick on unemployment rate. We got the slowdown in the pace of job creation. So that really tells you that the economy is likely to slow from sort of the breakneck speed that we saw in the third quarter. So that's easing some pressure from the bond market. But then I think there are two other developments this week that are really important. And one, of course, is from the Fed. They really are taking note in the long end of the curve and saying that is likely tightening financial conditions. But then you couple that with the announcements that we got from the Treasury this week, which is on the borrowing that they're going to do and exactly what they're going to issue. And I think that was a really good piece of news for the market, because they're not what they're going to borrow sort of met estimates or maybe even undershot it. And they're going to borrow mostly in the front end of the curve. So that's easing the pressure on the long end of the curve. So you put all of those things together, and I think we do have a recipe for a pause, if not a further fall in yields. And of course, John, as we talked about, you want to buy those spikes in yields. You want to buy the tech on those spikes. And hopefully investors have been doing that throughout October.
And Mike, you feeling a little bit more comfortable now in fixed income?
Yeah, Jonathan, I think the bond market, interest rates in the bond market are now actually just coming back down to earth. When they were hitting 5% and the Fed funds rate that was priced in permanently was pushing at 4.5%, I certainly thought interest rates across the curve were probably 50 to 100 basis points too high, that they overshot. And we saw that really with the inflection a month ago in the big jobs number we had. Of course, now with this volatility in the market, we've seen a full, as you point out, 50 basis point retrenchment, not only in the 10-year, but in the Fed funds rate expectations now are for a funds rate kind of in the 360s by the end of 2025 and 2026, which seems a lot more reasonable to us. So maybe now bonds feel more fair value.
So, Mike, what have you been buying this week?
Yeah, so, we actually took advantage, Jonathan, on the credit side. As you know, we were short duration probably most of the early part of the year. We covered that in and have been kind of neutral here with this big backup. On the credit side, though, as Mohammed pointed out, you actually had a big backup in credit spreads. I mean, high yield spreads widened over 100 basis points from where they were, a year and a half or so ago, and getting into the mid 400s was a pretty attractive entry point for us. So we've been buying a little bit of front-end high yield and other high-quality credit on the margin with the backup we've seen. But of course now that value proposition has kind of been wiped out pretty quickly as well. So really, like always in the markets, Jonathan, what to do now is always the hardest question.
Yeah, this is stuff we should have probably done yesterday. Anastasia, let's build on some of that and breathe some life into the equity side of the conversation. The banks this week, fantastic. This week, good. This year, terrible. Is there something to like now?
I mean, I don't like the banking sector, John. And, of course, like everything else, the banks can also rally into year end if we have this pause in yields and still constructive sentiment. But my concern about the banking sector is that I do think 2024 is going to be a harder year from the perspective of the economy, and especially from the perspective of charge-offs, delinquencies, bankruptcies, and defaults. And if you think about what one sector is most likely to feel all of that, whether it's defaults in commercial real estate, whether it's bankruptcy filings, whether it's consumers defaulting on perhaps their credit cards, I think it goes all right back to the banking sector. So for that reason, I'm a little bit more cautious on the banks. And then, John, the other issue, with the banks, there was a period of time where I did have some optimism for the sector, and that was predicated on the return of capital market activity. But we haven't seen really that return materialize in the third and fourth quarter so far of this year. So I think it's really too early to say that that's going to prop up the earnings of those banks. So I'm sticking with technology. And if you look, John, for example, at the NASDAQ, the S&P did pierce below 200-day moving average. The NASDAQ 100 never did, and it bounced right off of that level.
So from your perspective, the best way to play bond market stability, I should rephrase bond market stability as a bond market rally, is not through, say, the financials. You think it's still through tech?
Yeah, I absolutely think so. I mean, tech has gotten, I would actually characterize it as unfairly punished by higher bond yields. And when I'm talking about tech, I'm specifically talking about the profitable technology. And the theory goes that higher bond yields impact negatively tech valuations. And maybe that's true. But if you think about it from the fundamental perspective, tech is really not that much impacted by higher yields, because tech is one of the sectors that has the lowest leverage in the S&P. And if you think of tech, they also don't have a whole lot of oil leverage either. So I actually think it's one of the more immune sectors from these macro headwinds. And again, if I look at tech today, it's trading, lower in terms of multiples than it was during the summer. It's bouncing off the technical level. So I think that's the best way to play the retracements we're seeing in yields.